Basically, we had kind of an interesting quarter. Usually I give you guys a quarter at a glance, and if we take a look at October, we may recall in October we had a fantastic period of time. In fact, for the Dow Jones Industrial Average, it saw its third largest monthly gain in its 115-year history. So a lot of what we're going to be talking about today actually occurred and made a wonderful quarter out of the quarter was really what happened in October. And if we take a look at perhaps why that was, there was a couple of pretty big events that went on, and some issues that people found that were actually surprising, considering we had not had a positive return in the indices or in the funds for about a 6-month period of time. Particularly, we saw personal income and consumption were on the rise. We saw that Europe had reportedly, which we now know that they've done every other 2 weeks as well, but reportedly had a fix on their debt problems, and that really caused people to jump back in the market. But one of the themes that we saw, and even though we saw the NASDAQ rise 11.14% and the Dow only 9.54%, is that we saw people actually becoming a little bit more conservative. For the quarter, though, and again, because of October, we're going to see that it looks like people were really risk-seeking, when in fact, if we look on a month-to-month basis, which we will give a breakout for each group, that was not necessarily the case. Diversified leverage funds rose 23.35%. Basic material funds were up 17.13%. With the rise in oil and gas prices, we saw natural resources funds jumped up 16.76%, and the laggards were industrials, down 19.14%, and small caps pretty much took it on the chin, down 3.59%. So that was kind of the story there. But if we recall at the very end of the month, we had then the Prime Minister Papandreou come out and basically say that they were going to have a referendum on what Europeans had set up as a relief plan for them. This put a bunch of uncertainty back in the market, and I think really kind of led the way to November, and kind of a ho-hum type of November. We lost about 1.36%. with only about 18% of all equity and mixed equity funds on the plus side. But I do want to point out again, now the Dow had positive returns, 0.76%. It was the second consecutive months of positive returns, and that's where the story is going to continue on. It was kind of a popular area. Basically, though, we learned that there was really a lot of fear of contagion in the market. In fact, we saw some problems with Italy and a few other countries as well. Fitch came out and basically said, hey, listen, the U.S. banks are under threat as well with the sovereign debt issue, and as we recall, a lot of the press tried to find out what portion of U.S. money market funds even were holding, sovereign debt, from Europe and the like. So there was all those stories kind of circulating around, and people were really, even the most resound kind of bull was out there really being quite bearish at that time as well. And probably the last thing that I thought was very important is the U.S. Super Committee just failed completely to pair our national debt, which I think a smaller group, everybody anticipated that they might be able to do something. It turned out they did absolutely nothing. And I think this is one of those fears that kind of resonates through this whole quarter, is that there's been just the inability of governments to be able to do the things that they want to do. That said, we did have Fed and the 5 other banks, in reminiscence of what happened in 2008, really come to the rescue, so to speak, and said, hey, listen, we'll provide liquidity for the European banks. And in addition, we had China finally say, hey, listen, we might be headed for a hard landing. They took their foot off the brake and basically changed their reserve requirements, allowing it to decline by about a half a percentage point. So that was actually encouraging news, and in fact, it led to one of the best one-day performances we've had in over 2.5 years. You guys may recall that we had a 490 point increase in the Dow on that day, and it actually would jumped 4.2% in 1 day period of time. So really, with the Dow finishing at 12,045 and some change, it actually ended up to be a pretty good end of the month, but it really was due to that 1 day experience. Now, if we take a look overall, there was 5 funds that actually were in positive returns. We take a look at it. Natural resources was on the top, 0.84%. Health biotech was up 0.53%. And we actually had gold being up 0.36%. Now, that's not going to be a story we're going to be talking about here later on. Actually, gold really took it on the chin during the quarter. But on the bottom side, we saw that the India region funds was down 13.98%, and the commodities, agriculture took a hit as well, down 6.16%. Now on the plus side, I do want to point out two things. This is a trend that I'm going to be capturing here later on. The fourth best performing group was equity income funds. They only had about a 0.1% return, and utility funds had a 0.1% return. But this was one of the things that happened in November, December. We saw people doing a little bit more of a safety play and going after some defensive stocks, and the story will continue now as we go into the December time period. So we take a look at the December returns. It was the third consecutive month. We saw the Dow up 1.43%. The Nasdaq was down 0.58%. Really, there was a good month. We had 3 consecutive weeks of positive performance. Things looked pretty good. We had late approval of a tax cut and an extension. It was really more for payrolls, but again, it was something that was done at the last end, and people saw that as at least the Congress being able to get together and do a little bit of work together, whether you like the tax cut or not. And then the other piece was that we saw that the November durable good orders were on the rise. However, later on in the month, we saw Fitch come out and basically say, hey, listen, we're going to possibly change and downgrade the ratings for 6 sovereign debt issues. And that was of concern. So I think it put a pall over the system as well. Again, income players actually started to come to the top here. So we saw real estate funds. I think this was an income play as well as bottom shopping, up 4.31%. We had commodity agriculture up 3.5%, health biotech up 1.88, and here's where we started getting clobbered again with the gold area. AU, that's our precious metal classifications, down 13.2. Commodities, precious metals down 8.17. I'm sorry, 8.7%, and India region funds down 8.69. We'll talk a little bit more on that as we go. So if we take a look at the fourth quarter as a whole, it really was a grand quarter. It was the strongest quarter that we've had since Q4 of 2010, and basically we had 79 of our 86 classifications in the equity and mixed equity group posting positive returns. And if we take a look, it wasn't very surprising given what I was just talking about, and seeing that we've had an increase in European debt issues, we've had rising dollar, and we've had some issues in both India and China, that we see world equity funds at the bottom of the group. Still up 4.47%, but United States diversified funds led the way for the first quarter in 4 at 10.77%. And what was first was last, and last was first from last quarter. So diversified leverage fund just raged forward, up 16.92%. Small cap value and small cap core were the next in line with returns in the mid-15s. And then natural resources funds, of course, with the increase in oil, up 14.8%, did very good. The laggards, dedicated short bias funds, as we would probably expect. International India region funds down 16%, and then gold or precious metal funds down 5.71%. Now, here's where we get into a little bit more of the story and what drove a lot of this this return. First of all, we get that European region, the euro actually lost some value against the United States dollar along with its cohorts. So the dollar gained against euro 4.36%, the pound 0.58%, and the yen 0.75%, where if we look at commodity prices, they were mixed. Gold was down 3.37% for the quarter, but oil climbed an astounding 24.74%. Now, if we take a look, though, and look at the year overall, basically we ended up with the Dow up 5.53%. S&P was at a break-even point. These are price-only returns, by the way. NASDAQ was down 1.8. Unfortunately, though, funds were down 6% on average. A lot of this had to do with the heavier weighting in international and global holdings as well. And again, we'll show some detail on that as we go. If we take a look at the United States diversified equity funds, it was the first quarter in 3 that USDU funds actually rose to the top, and it was just a little bit of repeat of what I've already shown you. So this is the first quarter in 3 that they've been at the top, but diversified leverage was the main winner. Small cap value was at the top, up 15.65%, with dedicated short bias and equity market neutral funds at the bottom, or being the laggard of the group. If we take a focus on the December returns, now we're getting into that, if you will, dividend plays that people were going after, or conservative investments. Equity income funds were up 1.51%, and then we also had large cap value, which is generally a dividend player as well, up 1.2%, with kind of the growthier funds at the bottom. Mid cap growth down 2.15, multi cap growth down 1.48. As I take a look at this, though, one of the things that jumped out at me, at 2011 we had a minus 0% return. However, the two top performers for the year were equity income funds. They returned 2.85%, and S&P 500 index funds, which returned 1.52%. Going back to the equity income fund, interesting, they have not been a top performer in the United States Diversified Equity Group since 1974. So this is the first year equity income funds have become very popular. Matt's going to have a little bit more to talk about that later on in our flows, and I'll actually mention a little piece of it as we go as well. So that was a convincing piece that people have become more defensive in nature. As we take a look at this particular piece, and we are just basically looking at, this was a small cap in value, and I'll say core story. We see that kind of the large caps and growth are at the bottom, and that's really kind of what the story was as a whole. Obviously, dedicated short bias funds took it on the chin during the quarter. Getting a little bit better breakout, though, we see that for the first quarter at 8, value-oriented funds outperformed the other style groups. And on the flip side, if we take a look at the capitalization for the second quarter in 4, basically we saw small cap funds become the predominant player of 14.60. So remember when I first started, I said that people were a little bit more risk-seeking. That's what it appears to be here. But again, if we look at the actual follow-on months, that's not necessarily the truth. And here we take a look at the next grouping, and it kind of shows you that people went back towards a large cap value focus. Maybe not considerably, but again, large cap funds for the first time in 4 months, large cap funds rose to the top and just barely in the positive return area. And of course, value-oriented funds basically did a pretty good job of providing return, a 0.81% return as well. So that was the second month in 3 that actually occurred as well. If we get on to our sector group, this is one of the groups that actually contained 4 of the 7 classifications that posted negative performance. And so really, kind of the story was, I think mainly around the commodities. And I think in the next slide, once we get to it, you'll see why that is. So for the quarter, the sector equity group, again, containing 4 of the 7 really poor performers. And in fact, it was, though, the second best performing group. Natural resources funds were at the top, 14.82%. Remember, we had a very good increase, very strong increase in oil prices. The oil-laden natural resources group certainly benefited from that. Real estate funds were up 14.65%. Industrials did 12.93%. On the flip side, again, commodities just took it on the chin. Gold, precious metal funds now is what we call them, down 5.71%. Commodities, precious metals, down 5.2%. And commodity specialty funds down 4.28%. These are guys that are basically either leveraged or inverse. So we kind of have a mixed group there, so it's kind of hard to tell you what went on there. Sector equity funds, though, is the third worst performing group for the month, down 1.19%. But now here is where I'll say some of the value or dividend plays come in. Real estate funds were up 4.31%, health biotech up 1.88%, and financial services, okay, we all know that they all cut their dividends, but certainly people were bottom shopping, and I'm maybe thinking that they'll start adding dividends again, basically at 1.78%, and again, the laggard, gold, commodity precious metals, and general global natural resources as well. If we take a look a little bit closer on the 2011, the defensive position I was telling you about. So year-to-date, sector equity funds were down 5.5%, but really at the top of the group for 2007, utility funds up 8.68%, health biotechnology funds up 8.18%, and real estate funds tagging on 7.64%. So really a strong return period for, again, the dividend payers or some of the defensive sectors within the group. So as we take a look at our natural resources funds, basically, again, I've been saying it, strengthening oil prices really shot the natural resources funds up to the top. It's the strongest return they have had since fourth quarter of 2010. And at the bottom was what I was telling you about. It looks like what people were partying on last year, commodities, agricultural, base metals, specialty, and precious metals just really had a rough time for the quarter. World equity funds. As we take a look at the world equity funds, again, given the sovereign debt issues, slowing global growth in U.S. dollar, it wasn't surprising to see that they were the poorest performer at the 1 month mark, at the quarter, and at the year to date. So at the 1 month mark, they lost 2.49%. World equity funds, though, at the quarter were up 4.47%, and year to date we're down 14.06%. Basically, if we take a look though at the December returns, minus 2.49%, we'll note that the India region funds down 8.63% was really problematic. Emerging market funds down 3.78%, and this really has a common theme. If we take a look, everybody has been affected by this European debt issue. In particular, India actually brings in a lot of raw materials, and with the sliding rupee, they have had a lot of problems going on. And I think everybody will recall in December that the Prime Minister was trying to pass a bill in their Congress to basically allow Walmart to come in and be part of retail sales and own 51% of the ownership. Basically the merchants went to the streets in protest, saying, "Hey, listen, they're going to wipe out the small retail vendor out there," and they had to actually change their plans. So there's been a lot of a little unrest in India as well that's caused them to have one of the worst returns that they've had on record. In fact, if we look at the 1 year returns, 14.06% down year to date, or for 2007. Again, this is based on a hard landing in China, looming economic recession, and a slowing in U.S. growth. If we take a look at it, Latin American funds down 21.31%, China region funds down 24%, and India region funds taking it on the chin, down 37.65%, all three cellar dwellers. Taking a look at this particular group, contrary to the United States, the diversified equity grouping, basically investors said, "Hey, listen, we want to have large issues. That's where we feel the safety is." They were split on whether to go core or growth, and as you can see, there really isn't a great deal of difference between value, core, and growth, and really the predominant issue was one or two things. First of all, people wanted to go large, and secondly, the big performance came in the global end. So if you had a mixture of both global or international portfolio and U.S. holdings, you did better than being a pure international play in this, and we can certainly see that in the next slide as well. Global large cap core at the very top. Again, the global, if you take a look at the first 8 or 9 names, is basically global in there, and at the bottom it's international, and certainly that just kind of goes hand in hand with what we've been talking about over the last few minutes. Now this brings us to the returns for our mixed asset group, and there's been quite a few articles out there saying that mixed assets have disappointed again. Actually, for the quarter, I think they did a much better job than they have, than they did during 2008 when we had some problems there. Basically, for the quarter, they were up 5.65%. December, they were actually able to put positive returns. They were best performing group in December, up 0.06%. And for the year, they lost 1.34%. I don't know that there is a disappointing numbers as they've been saying in the news. But one of the things that and by the way, the returns range from absolute return funds 0.73% to 2045, target date 2045, up 8.68%. But one of the things that we did notice is that this has still become a very, very popular group for asset collection. Let me give a rundown of the 4 groups that I've been talking about, and you can see what I mean. Totally, we've seen flows for the year, and this is through November, so my number is going to differ from Matt's here. But we saw an outflow of about $20.4 billion out of equity funds. Here's how it broke out, though. United States diversified equity funds lost $119.1 billion. Sector equity funds saw an inflow of $13.4. World equity funds, surprisingly, still saw a 39.2 billion dollar increase, and mixed equity funds, after suffering the third consecutive outflow, saw an inflow for the year so far to November of 58.6. So you can see this has become a very important asset class for most investors, something that we definitely need to keep an eye on. So where does that take us? Well, basically, there is no clear resolution. We know that for European debt issues. I think they're getting closer, and we keep hearing on again, off again news. I think we're going to still have a ton of volatility coming forward. There has been slowing growth in both India and in China, and these are two of the biggest countries as far as growth rates go. I think they're both still around 7.5%, 8%. With growth rates, rising oil prices are a concern, and probably most recently, what I was reading from a Thomson Reuters proprietary research meeting is that basically when you take a look at the earnings surprise notices that are out there, there's an increase in negative earnings per share pre-announcements for the fourth quarter. They showed that there's 99 negative pre-announcements that were negative and only 30 that were positive, and their negative to positive ratio jumped to 3.3. It's the highest that they've seen since the fourth quarter of 2008, so that is somewhat concerning. Note that there's another statement below, though, in the but area, and I'll go into that in just a second. So back to the Lipper flows. This is more in line with what Matt's talking about, but one of the concerns that I've had is investors keep fleeing at least select equity asset classes, losing $133.2 billion. This is the estimates for year to date. Fixed income funds saw about 165.6. That would make Jeff fairly happy. What he saw, the muni bond fund is losing about 12 billion. Now that's a little different story because as of late we've actually seen pretty good flows into munis. I think that Matt will talk about that. And money markets funds saw about 119.6 as far as the net flows go. So in total, we saw about $102.5 billion flee the conventional fund business. These numbers are ex-ETFs. Now, one of the things that I've been watching, and you guys have all been watching, is non-farm payrolls actually got much better. 200K on the last one that came out. Unemployment rate dropped to 8.5. Actually, that is just the area we want to start going into. This is still very slow and not enough to really take down unemployment rate at 200,000 net new jobs, but it is in the right direction. ISM manufacturing and non-manufacturing numbers for December still are signaling expansion. And if we take a look at kind of the overall picture, the Fed remains accommodative. Corporations are still sitting on a pile of cash. And according to Thomson Reuters proprietary research team, Q4 earnings are set to grow at 7.8%. So things still are looking pretty good for this next quarter. Now, again, I'm not sure if we're setting ourselves up for do something well in the first quarter and then sell in May and go away, just like we did in 2011. But certainly, this is one of the things that I've been looking at. So I'm more than half cup full type of guy on this issue. I do have my concerns above. I think European debt issue is going to be a continuing issue. But on the flip side, the U.S. actually looks ready to continue on its slow growth pattern, and that still may be positive for some stocks out there. Well, that's it for me. If you have any questions, I'd be able to answer them now as well. But more than likely, what we'd like to do is continue on with Jeff's presentation here in a moment, and then answer those questions as we go. So please use your chat feature, and we can help you on there. So Jeff, over to you.